Welcome back. Still with me in the studio, Estienne de Klerk, who's the chairman of the REIT committee, a division of the Property Loan Stock Association of South Africa. We're looking at this property loan sector and the taxation, the work that's being done on taxation to eliminate or to bring it in line with other entities around the world, but also to attract the foreign investor into South Africa, because if he's going to be looking at a perceived double taxation, he's going to go, wait, hang on, I can put this money anywhere else in the world in property, a defensive investment. I'd rather go there. Give us an idea of this sector of the market. What is it worth? How much money is coming in? What amount of money would we like to see coming in? Give us some background there, Estienne.
So obviously the real estate sector in South Africa is a very, very important cog in our economy. I think SAPOA have the contribution to GDP at close to 15%. And you know, that's not very well known, and certainly government doesn't give the sector all that much attention, to be honest, but certainly uses it as a cash cow in terms of collecting taxes.
It tends to sort of run itself, doesn't it?
To some extent it does, and it's a very, very market-driven sector. It's very proliferated in that there are very many owners of real estate across the country, and to some extent it also has made big strides in transformation. So you will see today on the JSE many companies that in fact were started by black entrepreneurs and have listed subsequently. So it is a success story of South Africa. I mean, the South African listed sector as a sector has been the best performing investment class internationally for the past 10 years, which is a story in itself.
That is amazing.
If you've invested, the biggest counter on the JSE is Growthpoint Properties, of which I'm a director, right. I must point out. And you know, if you've invested in Growthpoint for the past, say, 10 years, you would have, and reinvested your distribution, you would have had a return of close to 1,220%. So the growth in the sector has been incredible, and certainly the wealth creation has been good for pensioners who are the bulk of the investors into the sector.
Just before we move on there, going forward, how do you see the sector performing going ahead?
Look, I think the fundamentals of the sector are reasonably solid. So if you go and look at the components, because it's mainly commercial in the listed space at this stage. So that's shopping centres, it's office buildings, and it's industrial property with a little bit of hotels here and there and maybe a hospital or two. Yeah. But fundamentally, if you go and look at each one of those three sectors, they are reasonably solid. There isn't massive oversupply in the real estate space, but the weaker sector remains the office market. And with our economy growing reasonably slowly at the moment, as well as nearly a structural change in the use of office space with companies going open plan, I think the office sector will remain under a little bit of pressure potentially for the next year or two. But fundamentally, your performance view will be to a large extent how you see interest rates unfolding in the next 2 or 3 years. And I've recently been in Europe, and trust me, from what I can see there, they're not going to be able to raise interest rates very soon. So I think if your view is similar to mine, that interest rates will be lower for longer, then the sector will perform pretty well. And you should be seeing organic income growth in the sector ranging between, on the lower end, maybe 3 to 4%, and on the upper end maybe 8 to 9%. So, you know, the sector has been growing right through what's known as the GFC, the global financial crisis. You know, to some extent South Africa ignored it, but was affected by it economically, and you know, certainly throughout that period, or this past, let's say, 4 or 5 years, the sector has managed to grow right throughout the time.
I suppose if you take that long-term view that interest rates are going to remain fairly low for the next 4 or 5 years, and you are in this listed property sector, I'm talking from the development point of view, if you're gearing your new projects correctly and using the bank's debt, which you're paying very little for, you're able to retain a fair amount of your own cash as well.
Yes, so how the sector fundamentally works is it doesn't actually retain cash. It pays that out. So all net rental is paid out to investors. So all incremental investment, so in other words, if we decided to do a new development for CMBC, for instance, a new facility, then we would sign a lease and we would generally then build the facility, and the rental is then what goes to investors. To fund the new development would usually be funded either by issuing units to our investors, in other words, raising new capital if you'd like, and the second form would be debt finance. So the sector is effectively funded by its investors and by debt, and all profit is paid out to investors, so it doesn't retain income. And if you go and analyze the whole sector, it is mainly a rental collection kind of model. So yes, there are big companies that are developing, for instance, Growth Point. There's a variety of other listed property companies that do develop, but mainly to own. And they hold those investments over the long term to generate growing, sustainable income, which they pay to the investors, who are mainly pensioners.
Let's go back to the international investors now. What sort of money do we see flowing into South Africa in this particular sector, the property?
So the big target market, if you'd like, in the international space is basically two kinds of investors. The first is a income or real estate specifically mandated investor, and then the second, it would be your general equities investors. Those would be typically the kind of investors that come to our shores. The kind of investor that has been investing into the local market to date has been generally the income or real estate specifically mandated investor. The general equity guys have been in the retailers, they go to the banks, they're looking for consumer exposure. But they come and chat to us. So once a week we have a general equities kind of investor in our office, and they start with trying to find out more or less what's happening in our retail portfolio, how's trade going, how are the retailers trading, and then they kind of get an idea of how much exposure we have to turnover rental. Now, in the South African context, turnover rental is not that a big income spinner for us. And the bulk of our rental is kind of from rental agreements where it's a very predictable income growing at roughly on average 8% per annum. And that really is the kind of exposure in the portfolio. Now, if you go and analyze these investors, they're looking for yield. So they will, if a share is trading at R1 and they're looking for it for a 10% return, then they're expecting a distribution of 10 cents. And if yields go down, so the interest rate market contracts, then obviously the price will go up, but the distribution usually is quite predictable, and that remains the same. And obviously companies that grow that distribution quicker will see better growth in the actual share price underlying. But the sector is very much yield driven, and there's a bit of a correlation between the trade of the sector and long bond yields. So if long bond yields contract firm, then you'll see a good spike in the prices of listed property. So if you've seen in the past quarter, the sector has probably jumped on average between 15 and 25%, and that has been to some extent with the interest rate market contracting from to where it is today at lowest levels ever.
You see on a weekly basis that foreign investors were net sellers of X billion rand and net buyers of X billion rand of that. What sort of, it must be difficult to put an absolute number to it, but what sort of percentage is going into the listed property sector of the market?
Yes. Generally, these investors are institutions, so they'd be asset management houses that have mandates from pension funds to manage money, and they have minimum requirements in terms of scale and liquidity. So they expect that they expect a investment where they can buy roughly $10 million or sell roughly $10 million. Now, if you go and look at our listed property sector, which is really still in fledgling stage to some extent, where 10 years ago, I think the total sector market capitalization was maybe 15 billion rand. Today it's close to 200 billion rand. So it's grown exponentially, but there are quite a lot of companies which are reasonably small and still not that liquid. So there's probably 5 to 6 larger listed property companies where you see these foreign investors invest in. And there were times when they went into the smaller ones, but after their experience in 2008, where they saw outflows out of their funds, and when they tried to liquidate several of their investments locally, they actually saw quite a lot of pain. These guys are generally more conservative, and they go into the bigger stocks. So in the bigger stocks, you'll see their exposure up to about 15.5%. And growing. So this number is growing annually. We've seen in
so they have confidence in the South African market.
100%. They generally the South African market is probably the largest investment space in property internationally, internationally in the emerging markets space. So if you go and analyze most of the other emerging markets, their listed property is quite often home builders and construction companies. Where in South Africa it's quite unique that the bulk of our listed property companies are rent collectors, investors in commercial property, very predictable earnings, and a much more yield play, if you'd like. So what we have seen is that it has been a very attractive space for them, and you know, the guys that have been in for 10 years seen 1,000% growth plus, you know, compared to the international space where they've seen, you know, if you've been in America, maybe over the past 10 years you've had 100, maybe 150% growth. If you've been in Australia, the UK, Europe, your money's gone nowhere for 10 years. So you've effectively only had a yield over that period and no capital growth because of what's actually happened in those markets structurally.
Very briefly, because we only got about a minute left on the show. From a personal point of view, the market in South Africa, the property market in South Africa, are you still positive about it?
Yes, I believe interest rates will remain sort of subdued and low, and I think the fundamentals are strong. And the companies generally on the JSE are very transparent and well managed. And I do believe that the yield that they offer investors is attractive. So if you're earning a 6% yield growing at between 6 to 8%, I think it is a very attractive investment class for investors, and it provides diversification for them.
Estienne, thank you very much for your time. It was a fascinating conversation, really was.